Welcome back to Advance Your Wealth, the video and podcast series from Convergent Wealth Partners. I'm Homer Smith, and I'm here again today with Frank Seneco from Seneco and Associates to go over some additional advanced planning ideas. So far, we've covered benefit-focused defined benefit plans and private placement life insurance and annuities on previous episodes. So if you missed those, I would highly suggest you go back and review those videos. Lots of great ideas and tips on how to take advantage of some of these advanced planning ideas to better your overall and optimize your overall situation. So today, though, we're going to focus on a couple of different topics. They're advanced, and we're going to get into a little bit of the details, but we're going to try to keep it high level and just kind of start the conversation around things like premium finance, life insurance, and different types of benefit plans, deferred compensation plans for private business owners. So with that, Frank, welcome back again. Let's just jump into it. Tell me a little bit about the idea of premium financing life insurance. Why would you take a loan out or use premium financings to buy life insurance? And really, what is this all about? I've heard about it, but give us a little bit of an idea of what this really is all about.
Thank you, Homer. It's great to be back with you. Premium finance life insurance is a strategy that has been around really, I'd say, since the late 90s, but it is where a client will borrow funds from a third-party lender, typically a bank that specializes in lending on life insurance contracts. And they're going to borrow the premiums to fund the life insurance, with the overall strategy being that the life insurance is going to earn more than the cost of the dollars borrowed. That's the general concept of it. So I'm borrowing monies to fund a life insurance contract to take advantage of positive arbitrage, that the insurance policy has the ability to earn more than my cost of funds.
Got it. So, who might be, and obviously arbitrage makes sense. And we talk about that a lot with clients, and oftentimes clients will borrow funds to invest and use margin for that same idea. So it sounds kind of similar in this area. Who would be the best type of candidate for looking at, premium financing life insurance? What are the situations you run into most often?
Well, the ones I run into most often are, there's two focus areas. It's really from the estate planning side, where a client needs a large block of life insurance, and either they are limited on their gifting ability to fund the premiums on an annual basis, so we'll borrow the premiums from that third party lender, and the client will either fund the insurance every year, which is fund the interest every year, which is a lower fee than the outright premium. Or the client will turn around and use this as a way to leverage to help enhance retirement income. So I've seen two sides of the spectrum, whether it's borrowing to fund a very large estate tax liability, or they want to use this as leverage to hopefully fund up a policy that's going to earn a greater amount than their borrowing cost, and use that as a retirement supplement.
So over time, let's play this out, over a 5 or 10 year period. What are the benefits of utilizing the strategy? We don't have to get into a spreadsheet and kind of look at the numbers necessarily, but, kind of understand the idea of leverage in general. So, fast forward 10 years, what's the idea of how this should play out over a time frame like that?
Well, let's focus more on the estate strategy.
Okay.
But it's really where the client, they will fund the policies, and it's a fixed version of a life insurance contract, whether it's a whole life, universal life, or something like an index universal life. There are limitations on funding a private placement or a variable life. So you're really going to use one of the fixed insurance-based products. We're going to fund at a very high premium to fund that policy up at a very fast rate, and also get monies in there to take advantage of the tax deferred earnings and the compounding. So usually we see index universal life policies are being used. They fund the policy over 5, 7, or 10 premium contributions, borrowing the premium each year. They can either pay the loan interest or they can accrue it. And over the 10 years, you want to have where the policy has outperformed the loan, and you'll have a positive cash in the contract over the loan. I like to equate this to, it's like a commercial real estate loan. You have a piece of property being the insurance, And the focus is that's going to appreciate on an annual basis faster than you're borrowing on an interest-only loan.
Got it. And so, another way maybe to think about it, or another area where it might make sense, is if you have a large insurance need,
Mhm.
maybe you have some smaller cash flows now, but in the future you can see whether it's again through a business sale or some other trigger that those incomes are going to be significantly increasing. You might utilize this strategy now, knowing that additional cash flows are coming in the future. Is that another way that this might make sense?
Yes, it could be a temporary situation when we tie this to some estate planning techniques such as grats or sales to defective trusts, where at the end of a certain period, assets that have been moved out of the estate now are available to fund premiums. So we might borrow premiums for 7 years, as an example. Around year 10 or 11, maybe that other planning, the grat or the defective trust cash flow becomes free, and then we'll pay off the loan. So it's another way of locking in the client's insurability, taking advantage of that tax deferred compounding because it's a permanent insurance need, and then we might pay off the loan from outside funds.
Got it. So kind of in each of our conversations, all the strategies we talked about are pretty complex and they've got some pretty compelling benefits to them. And life insurance in general, with the tax deferral and potential tax-free withdrawal and tax-free life insurance benefits, lots of benefits around these types of plans. But with those types of benefits also come mistakes, pitfalls, advisors that are being too aggressive with the use of this type of strategy. So, with premium finance life insurance, what are some of the mistakes and pitfalls that you see being made out there that maybe you're again too aggressive, or just not utilizing these the way they should? What are some of the mistakes that you see being made out there?
I mean, the biggest thing that I see is clients aren't aware of uh, that they have to potentially post collateral for any shortfall between the policy value and the loan. If they walk away from the transaction, they could have a call on that collateral, whether it's a securities portfolio, a savings account, or even real estate. That's one thing. The loan interest rates are subject uh, to fluctuation, which if we're going into a higher interest rate environment, they could have a higher loan interest payment. And the policy performance is not there, so you don't get the right arbitrage. I mean, it's a great transaction. It's just something that needs to be monitored.
Yeah, so you can't set it and forget it. You can't put
Yeah.
this plan in place and then go 7 years later and see if it worked. It's something that's got to be managed on an ongoing basis.
Yes.
Great. Well, good. Well, it sounds like again, if you've got some complex planning needs where there is a large need for life insurance, but potentially some lower cash flows now, but future cash flows will be larger, or some estate planning needs where this could make sense. Definitely an area that we should be reviewing and stress testing and seeing if it might fit into your situation. But in our time today, I also want to cover one other topic. A lot of the clients I work with are private business owners.
Mhm.
The nature of the environment that we're in is that it's been more difficult to hire, retain quality employees, and so business owners are looking for ways to reward and retain their top performers and their management team. So beyond traditional retirement plans, 401ks, even defined benefit plans that may have discussed on previous episodes, what are some other solutions that you're seeing business owners take advantage of and utilize to reward and provides, maybe even look at providing succession planning within the business?
Sure. I mean, there's a few different things aside from the qualified plan route, like you mentioned, the defined benefit plans and profit sharing plans. I mean, there are non-qualified plans that can be put together. These are certain things of non-qualified deferred compensation, which can be funded by the business setting up either something called a rabbi trust, as an example, or a supplemental executive retirement plan, a SERP. And that could be something where the business is going to fund monies into, it could be a brokerage account if they chose to, or life insurance can be the funding vehicle. And they're going to promise them if they stay with the company for a long enough period, they'll get a supplemental retirement income. Typically, what we do is our plans have life insurance benefits because, again, the business is taking advantage of that tax deferral. If you are using the life insurance contract, if something happens to the executive prior to retirement, if they pass away, the plan becomes fully funded and the family can get a benefit and even an additional death benefit on top of it. The one thing with traditional non-qualified deferred compensation is that it is subject to the claims and creditors of a business. So that's one thing to keep in mind. But we see this is something that's been utilized in medium to large corporations, for years. Other things that can be done just for the employer-employee relationship, the non-owner, I know we're going to ask about this. There's certain versions of split dollar, where really the business can do this on more of a one-off basis without a trust or a SERP agreement in place, where the business funds a policy and they give the employee the right to name the beneficiary. At some different triggering points, the cash value can be transferred over to the employee as well. So there's different planning techniques that can be utilized when
And
you're
when you
putting
say,
together something.
oh, sorry, Frank. So when you say split dollar, what does that mean from a life insurance standpoint? I mean, I understand that it can be a one-off for a specific employee, but what's the split dollar nature of it?
Well, the split dollar concept is really we're splitting the use of a dollar between two parties. So in a very simple explanation, it's where the employer will deposit funds into a policy. Upon the employee's passing, the employer would get back the monies that it put into the contract. Could be also the monies it put in plus the total cash value, and that net death benefit goes over to the employee's beneficiary. So it gives the ability where they can lock in permanent insurance for an employee and have the ability to recoup their funds. Also, that can be used as a part of a golden handcuff. But overall, it's another form of a loan. It's not premium finance because financing is done with a third-party bank, but it is a version of a loan where you have one party lending funds to an individual, a trust, and upon the passing away, they're going to get repaid, or during lifetime, they may transfer that money that was advanced over to the employee.
Got it. So lots of opportunities here between deferred compensation plans, maybe using some split dollar life insurance to focus on a top employee or management team member. How else do you see life insurance being utilized as part of succession plans for business owners?
Typically, I mean, what we'll see is the most traditional succession plan is going to be a buy-sell agreement between owners, where let's say if you and I were partners in a business, either the business takes out a policy on each of us, and if one of us passes away, it's going to be used to buy out my or your heirs, whoever has passed away, or you and I could take a policy out on each other. There are different tax benefits associated with doing either type of a strategy. So that's a typical buy-sell agreement. We may have where an individual has a key employee. Let's say I own the business 100%, you're my key employee. And if something happens to me, my family's not going to be able to run the business, but I want to give you the ability to buy out my business interest. So it might be, again, where the business takes out a policy, or you'll own a policy on my life, and you're my employee, though not my partner. And then we'll have a separate agreement for the fair market value of the business. If I pass, you're going to use those funds to buy out my heirs. Another thing as well could be a version of key person insurance. So key man insurance, key person, key man. I mean, it's really for a valuable employee, whether it's if something you were key to me and something were to happen to you, I can have a policy that's going to give me some time before I'm able to buy out, buy out, that's the wrong term. I'm able to replace you because you're such a valuable employee. You might have a key person insurance on me as well as the buy sell, because not only are you going to utilize monies to buy out my heirs, but you need some money in the company for you to get things going. So there's different versions. It's business typically will own a policy either for a buyout purpose or providing funds in the event of a key person passing away.
Got it. So lots to think about here from the show today. So we've got premium finance life insurance, deferred compensation plans, split dollar plans, key person plans, different types of buy-sell agreements and succession planning. So a lot of great uses where you can use the leverage of life insurance and the tax deferred nature of the growth inside of the policy and the tax-free benefits of it to really enhance what you're doing within your business and providing benefits for not only you and your family as a business owner, but also potentially for your employees. And especially right now, again, with all the challenges that we're facing with finding and retaining top quality talent, really looking into how these types of plans might be a benefit for you. Really, you probably couldn't be a better time. So if you think that any of the topics that we discussed today might be something that would make sense for you, we'd love to hear from you and love to review your overall situation. So send me an email at homer@convergentwealth.com. We partner really closely with Frank and his team to really dive deep into these strategies and make sure that they're really the right type of benefit for you and that it really makes sense. Because as we've talked in all of these episodes, there's a lot of pitfalls out there and mistakes being made if these aren't structured correctly. And so we want to make sure that it really is a good fit for you. But if it is, lots of leverage and lots of powerful strategies that can be implemented here. So once again, Frank, thank you so much for your time. This has been fantastic. I'm sure we could spend another hour or two going into other advanced life insurance topics, but just really appreciate your time and kind of kickstarting us down this road for our clients and diving into some of these areas.
Thank you, Homer. It's been great being here.